3. Chapter 3 is about understanding how value is calculated when the cash flows from a particular activity happens in the future or is distributed across time. So let's say you have two alternatives of receiving $1,000 in cash today versus $1,000 and $1,100 a year from today. Which of these two opportunities would you avail of? Well, you cannot directly compare 1,100 with 1,000 because 1,100 is a year from today. So either I have to take the $1,000 that I have today and ask what will be the value of this a year from now, or I would have to take the 1,100 next year and bring its value and ask what would be that $1,100 worth today. In other words, the only way we can compare economic opportunities across time is to reduce them into common time frame, i.e. either we state all cash flows in terms of their present value, or we state them, which is today, or we state them in terms of their future value at some point in the future. A year from now, 2 years from now, 3 years from now, and so on. So we have to convert cash flows into their common frame. And so that's the task that we have to in this chapter. What is the framework through which we approach this analysis? So what we do over here, we start with a very simple cost and benefit analysis. And then what we really want to dig into is the time value of money and the role interest rate plays in determining what is the time value of money. And once we establish that framework, then we can value cash flows that occur at different points in time. So that's kind of the course objective. So in terms of a cost-benefit analysis, it's pretty straightforward. We are going to look at costs, and we are going to look at benefits, and we are going to say that the net present value from any activity that we have, the net value that we generate from any economic activity would be the present value of all the benefits minus the present value of all costs. And if benefits outweigh costs in their common framework, in their common present value framework, then the net present value is going to be positive. And in this case, of course, we are going to go ahead with that opportunity because the benefits exceed costs. So to compare costs and benefits, we have to convert them to a common unit. That's what this technology is, the technology of calculating present value, which we will be talking about quite a bit in this course. So quantifying, how do we quantify costs and benefits? So you have a jewelry manufacturer that's the opportunity to trade 200 ounces of silver and receive 10 ounces of gold. Is that a fair trade? Only way we can ascertain if that is a fair trade is to convert the 200 ounces of silver into their dollar value at a cost of $20 per ounce. And then we can convert the 10 ounces of gold into their dollar value at $1,000 per ounce, and only then we see that the net is in favor of the dollar. The opportunity of benefit is $10,000 today against a cost of $4,000, so that's the benefit. Since everything is today, we did not have to change anything into present value terms because they were already in present value terms. So benefit minus cost, that's positive. Since that benefit minus cost is positive, we accept the project, or we accept the trade. We accept the opportunity. So in a competitive market, what we are looking for as a characteristic of the market is that the price of a good is based on the value that the good generates, and that the price is fair, meaning it is being priced to reflect its actual value. If something is worth $1,000, then the price at which it is trading in the market is $1,000. If it is not, if something is worth 1,000 and it is trading at, let's say, 1,100, then what would we say? We would say that the item or the asset is overvalued. That's one aspect. The second aspect, if an item or an asset is overvalued, what do we do with it? What we do with it is we trade on that information. So if the asset is overvalued, we would sell that asset, and we will use the proceeds from that sale we'll buy the asset at 1,000, and then we will be able to sell it at 1,100, and we will be able to make some extra cash. That extra cash that we make is often described as arbitrage profit. So that opportunity, has to be determined through deliberate action. We have to determine to see that what the fair value of the asset is, and at what price is the asset trading in the market. Once we make that determination, then we can have a better handle on what the arbitrage opportunity is. Is there any opportunity to make extra cash, or what we call arbitrage profit? Something that we can take a look at in this chapter. So here is an example of how to determine value. It's a really, in some sense, a silly example, but nonetheless, it makes the point very well. You won a radio contest to learn that the price from the radio contest is 4 tickets to Def Leppard with a face value of $40 each. But you also find out there's a second show, and 2 tickets are being sold at a face value of $45. You notice that on eBay, the tickets to Def Leppard show are being bought and sold for $30 a piece, and tickets to your favorite band are being bought and sold at $50 each. What should you do? Not using your emotion, if you're trying to determine valuation using cold, hard, objective facts, how should you value this proposition? Well, first, you start putting a dollar value to it. 4 Def Leppard tickets are being sold at $30 a piece, and 2 of your favorite bands is being sold at $50 a piece. So you need to compare the market value of each option, and then objectively choose the one with the highest market value. How do you do that? So Def Leppard tickets have a total value of $120, 4 tickets each at $30 a piece, versus your favorite band, 2 tickets each at $50 a piece, has a total market value of $100. So instead of taking the 2 tickets of your favorite band, you should accept the Def Leppard tickets from the radio show, then sell them on eBay at $120, and then use the proceeds from that to buy the tickets for your favorite band at $100. You would have $20 left over. You would see your favorite band and have $20 left over to buy some t-shirts or concessions. That would make the most sense from a value proposition. And that also explains to you, begins to underlie to you the underlying idea of how is arbitrage conducted. It is trying to look at value and trying to engineer a set of trades that allows you this kind of profitability. an excess profit over here. Now, this can be translated into more economic terms with financial assets, something that we will see in this course and in other finance courses. Okay. You can look at other variations of the same problem as you work through the rest of the slides over here. So that brings us to what are the basic valuation principles that we use in finance. Number one, that the value of a commodity or an asset is determined by competitive market pricing. That means in an open market where assets are being bought and sold, the supply and demand of these assets, the intersection of the supply curve and the demand curve, creates for us the fair value or the market value of the asset. So that means that we have to look for marketplaces where assets can be bought and sold fairly easily, markets where there are multiple players in the market, both buyers and sellers, so it creates a sense of competition, and markets that also have transparency with their information. It is not difficult to find out information that is relevant to determine the fair value of an asset. So the benefits and costs should be evaluated using these market prices that we have determined through a competitive process. And when the benefits exceed the costs, that would then increase the market value of the firm. So to attain the objective function, maximizing shareholder wealth, we have to constantly increase the value of the firm within the constraint of risk. And to increase the value of the firm within the constraint of risk, we have to look for opportunities where the present value of the benefits exceed the present value of the cost. Present value of benefits is greater than present value of costs. That's the game in valuation, that's the game in business. Every opportunity has to be evaluated from a cost-benefit sense. And the first aspect of that evaluation requires us that we state all the benefits and all the cost in terms of a common framework. And the common framework is present value. Okay, so here we have example of applying the valuation principle. You have the opportunity to acquire 200 barrels of oil and 3,000 pounds of copper for $25,000. The current market price of oil is $90 per barrel and copper is $3.50 per pound. You are not sure that you need all the oil and all the copper, so you're wondering if you should take this opportunity. How valuable is this opportunity? And would your decision change if you believe that the value of copper or oil would drop over the next month? All fair questions in standard normal businesses. So the first thing we have to do, we have to quantify the benefits and costs. So we have 200 barrels of oil at $90 a piece and 3,000 pounds of copper at $3.50 per pound. So we take 200 barrels, multiply that by $90 per barrel. So the value of that oil is $18,000. We have 3,000 pounds of copper at $3.50 per pound. So the value of the copper is $10,500. Okay. So you are receiving this value of 18,000 plus 10,500, 18,000 plus 10,500, that's 28,500. That 28,500 of value you're receiving against a cost of 25,000. That means you're better off by $3,500 today. And since this is positive, this value is positive, of course your decision should be go for it. Okay, so that's how we take a principle and convert that into numbers that we can assess our decision making. And if the price changes, of course, your decision would change. If the price of oil was less, price of copper was less, and you had to pay more, then of course, this plus this minus the cost, in this case now it's negative, and then you should not take it. So that's how we would evaluate. We are beginning to now put together the framework under which we assess the viability of investment opportunities. Okay. So similar examples, you can work through them on your own. In a competitive market, there can be only one price. One price for each good at a certain point in time. If a particular good has two different prices in two different markets, this is market A and this is market B. Same good, $25 in one market, $30 in another market at the same time. Then what are we seeing? That it's a violation of this law of one price. But so what? So what if two markets exhibit two different prices for the same good at the same time? The key is same good at the same time. Why do we care about it? We care a lot because the first thing is that it uncovers a profit opportunity for us. i.e., what we can do is we can buy this good over here and sell the same good in location B. So we are going to sell, so we're going to receive $30. That's our benefit. We are going to buy it at $25 and we are going to make a profit of $5. That profit of $5 can be described as what we call arbitrage profit. Because it's profit that we are getting almost guaranteed and at virtually no risk. For example, I could buy this by borrowing $25. Let's say I don't have $25. I can go to a bank, borrow $25, use the $25 to buy the good over here, and then immediately sell it in location B at $30. I will then return the $25 to the bank plus some interest, and I will have still a profit that would be close to $5. Not exactly 5, it'll be $5 minus the interest that I may have to pay to the bank. So that's arbitrage. And in a market that is to be governed by this law of one price, arbitrage opportunities cannot exist. In other words, in a competitive market, we have no arbitrage pricing. That means prices reflect the law of one price. In a competitive market, securities with the same cash flow, securities that are identical, two goods that are identical, two financial securities that are identical, must have the same price. If not, then we have this unusual opportunity to make profit that we call arbitrage profit. So the arbitrage is then the practice of buying and selling equivalent goods to take advantage of their price differences. A more technical way of defining arbitrage is to make profit without any investment and without any risk. As we have done over here, we borrowed the $25, borrow, buy, and then sell. Since I borrowed the money, I did not literally use my own money. That means there's no investment from my own pocket. I use borrowed money to invest. And since I bought and sold simultaneously, there was virtually no risk of that $5 profit. So I'm not only taking advantage of price difference, which is normal trading, but I'm doing this without taking money out of my pocket and without incurring any risk. So it's possible to make a profit without taking any risk or making any investment. That's the key to arbitrage. So that completes the first part of chapter 3.